how do we compute depreciation expense? There are three methods. We would consider here straight line depreciation method, accelerated depreciation method, and unit of production method. We would get started with using straight line depreciation method. To compute depreciation expense, as far as this illustration is concerned, depreciation expense using straight line depreciation method is the historical cost minus salvage value. It is worth noting that salvage value is also known as scrap value. It could also be known as residual value. So it is historical cost minus salvage value all over the useful life of the asset. The historical cost is the cost the asset was acquired or was purchased, which is 100,000 US dollars. Then minus the salvage value. The salvage value is 20,000 US dollars, all divided by the useful life of 5 years. That implies that the depreciation expense on a yearly basis will be 16,000 US dollars. Now, let us move on to using accelerated depreciation method. To be more specific, our focus will be on double declining balance method depreciation. The formula for double declining balance depreciation is 2 all over the useful life of the asset times the book value at the beginning of the year. It is worth noting that the book value at the beginning of the year is the historical cost minus accumulated depreciation. What we have here is called depreciation rates. Depreciation rates, as far as this question is concerned, would be 2. The 2 is coming from double because we are dealing with double declining balance method. So that's 2 divided by the useful life of the asset. The useful life of the asset is 5 years. That implies that the depreciation rate is 40%. On the previous slide, we agreed that depreciation rate is 40%. To compute the depreciation expense on a yearly basis, let us look at this table. An asset was purchased for 100,000 US dollars at the beginning of year 1. So we have the beginning book value for year 1 to be 100,000. The depreciation expense would be 40%, which is the depreciation rate, times 100,000, and that is 40,000. To compute the ending book value, it will be 100,000 minus 40,000, which is 60,000 US dollars. This 60,000 US dollars would become the beginning book value for year 2. To compute the depreciation expense for year 2, it will be 40% times this beginning book value, and that would give us 24,000. To compute the ending book value for year 2, it would be the historical cost minus the accumulated depreciation. The historical cost of this asset is 100,000. The accumulated depreciation by the end of year 2 is the summation of these two, that is 40,000 plus 24,000. And that would be 64,000. So 100,000 minus 64,000 is 36,000. But there's a faster way to compute the ending book value for year 2, and that would be 60,000 minus 24,000, which is 36,000. The 36,000 becomes the beginning book value for year 3. To compute the depreciation expense, it will be 36,000 times 40%, which is 14,400. To compute the ending book value for year 3, it will be 36,000 minus 14,400, and that would be 21,600. It is worth noting that we will only be depreciating 80,000 of this 100,000 since the salvage value is 20,000. How did I get this 80,000? It is 100,000 minus 20,000, which is 80,000. Since at the end of year 5, the asset will be worth 20,000. So if that is the case, we need to stop depreciation soon. Summing the total depreciation together here, that would be 78,400. That implies that what we have left to depreciate will be 80,000 less 78,400, and that is 1,600. So the remaining amount will be depreciated in year 4. Moving on to units of production method. An asset was purchased for 100,000 US dollars with an estimated useful life of 5 years. The salvage value is 20,000 US dollars, and the projected units that will be produced on a yearly basis include the following. Please note, all the figures we have here, they are all in millions. So let's get started with computing depreciation expense. So the first thing is, what formula do we use? The formula we use is similar to what we used under straight line depreciation method, which is historical cost minus salvage value. But instead of dividing by the useful life of the asset, you would simply multiply by the unit produced in the period involved all over the total production units. The total production units is 10 million. If you are interested in the depreciation expense for year 1, it would be historical costs, which is 100,000, minus the salvage value, which is 20,000, then times the unit produced in year 1, which is 2 million, divided by the total units across the 5 years, and that is 10 million units. So I'm sure we should agree with this formula so that we are all on the same page. I have computed the depreciation expense for each year. Just as a quick revision, imagine we're interested in computing the depreciation expense for year 5. It will be the historical cost, and the historical cost is 100,000. So that would be 100,000 minus the salvage value. The salvage value is 20,000, then times the unit produced in year 5, which is 1 million, divided by the total estimated unit, which is 10 million. So if you solve for that, you should have 8,000. From what we computed on the previous slide, you can easily deduce that the depreciation expense on a yearly basis is dependent on the estimated units produced on a periodic basis. When the unit produced was on the high side, then the depreciation expense was also high. When the unit produced was on the low side, then the depreciation expense was low. Using the unit of production method, the depreciation expense reported each year varies with the number of units produced. From the previous illustration, we computed straight line depreciation as this. Then we also computed accelerated depreciation as this. You would want to agree with me based on what we can see here that if we are using accelerated depreciation, you would recognize a higher depreciation expense in early years, but in subsequent years, as in later years, you would record a lower depreciation expense compared to when using straight line depreciation method. So that implies that when using accelerated depreciation method compared to straight line depreciation method, you would record a lower net income or net profit in early years. And the major reason is because of the high depreciation expense. But in later years, when using accelerated depreciation method compared to straight line depreciation method, you would record a higher net income or net profit, and the major reason is because of the lower depreciation expense. In early years, compared to straight line depreciation method, the accelerated depreciation method recognizes a higher depreciation expense in early years. Thus, we can say that the income before taxes, the earnings before taxes, will be reduced if the income or earnings before taxes are on the low side. That means the taxes payable by such company will also be reduced. And it is also worth noting that the net income will be reduced from what we discussed earlier on this slide. From a cash flow perspective, to be more specific, cash flow from operating activities, when using accelerated depreciation, improves due to tax savings. And the major reason is because the company using accelerated depreciation would pay lower taxes. The tax authority will only tax you if you make income. If you make losses, the tax authority will obviously not tax you. So that implies that the higher your income before taxes, the higher your earnings before taxes, then the higher your taxes. The lower your earnings before taxes, then the lower your taxes. So if your taxes is on the low side, as we said, when using accelerated depreciation, that implies that your cash flow from operating activities will be improved. It will be improved because what you pay to the tax authority is on the low side.